FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You're listening to the Financial Survival Network. It's Kerry Lutz. With us is Gordon T. Long. We are talking about what's going on in the real economy, not the economy that you see on the nightly news, not the economy that the politicians are telling you is just fine and is overflowing with jobs, prosperity, and truth and justice for all. Gordon, how are you?
Couldn't be better, Kerry.
But
it isn't because of the nightly news.
Yeah. Well, I haven't watched it in years, and it's just pure propaganda, nonsense. I mean, you look at what's happening here. We talked about it a while ago, how all of those nice, happy subprime auto loans were going to start defaulting. That's going on now. All of these things that we're seeing, not the sign of a healthy economy, but somehow you got to find a way to keep your head above water, to keep going on. And, we just seen so many bad things happen right at the end of the year, the beginning of the new year. It really is beginning to look like 2015 is the year.
It certainly does. And we got a lot of charts that suggest by Q3, that is September, we got a lot of inflection points kind of coming together. So we're running out of runway. Quantitative easing is failing. It's not working. We're 6 years into a recovery, and here we got today Europe announcing 60 billion a month euros, 1.1 trillion euros. Why? After 6 years, I thought that everything was under control and the recovery was fine. Of course, I understand that they've been in a continuous recession. But, Kerry, you started by saying the information and the nightly news and propaganda, it used to be spin. And then it went to misinformation. And now I think it's just out and out obfuscation. It because there's so many things that I don't think anybody's trying to lie to us. It's just that they don't want to tell us the truth and force us into a Pollyanna because they don't want us to be negative. It impacts the consumer. But if we knew the truth and we knew what was really going on, I think we could be more realistic as a society, because our economy is not recovering. I see the statistics, and as you know, I bury through them. And, Gallup poll, Kerry, came out with a survey this week that showed in the last 6 years, 70,000 net enterprises have been destroyed in America. And by that number, I mean they take the number of new companies that are starting, and they take the number of companies that are failing, and they say, here's what the difference is. We used to run 60 or 70,000 positive. How do you take 70,000 enterprises out of America, net loss in 6 years, and call that a recovery? You got 648 million working age people. But you've got 102 million not employed, close to 50 million on food stamps. That's not a recovery. And the irony is, the United States is considered to be the stellar example of the best economy in the world right now.
Yeah.
So, but we need to face the realities. We need to face so that we can then start to focus on what the solutions should be. You mentioned these student loans, or rather car loans that we talked about. And we had a long discussion 8 or 9 months ago about the severity of the problem. Well, now it's just starting to surface. And the amount of defaults, the amount of that are going in arrears. This is going to be another shadow banking crisis, the same as we had in 2008. It won't be mortgages. This time it's going to be student loans and car loans.
It's a great point. And by the way, we were also talking about mortgages, and that they raised the down payment requirement, increased the credit criteria, and that as a result, government-backed entities, the GSEs, Fannie and Freddie, were only making half the number of loans that they had made the year before, and commented, this can't be allowed to stand because without a healthy housing segment, we're not going to have a healthy economy. So they were going to cut back on that. And I'm sure you caught it last week or the week before. Hallelujah times back, 3% down, and everybody will be able to buy a house again. Isn't it wonderful, right?
if they have a job and their real disposable income is going to allow it.
Yeah.
And so right now, it's not the mortgage rate that's slowing. It's not stopping people from buying. It's not even the down payment. As a matter of fact, the youth today don't want to buy a house. They don't want to. They don't. They've grown up and listening to their parents being either house broke or mortgage issues or whatever. They don't want that. And generally, more of the youth that I talk about, they are into rental property, and that's where their cash allows them to go.
That's the millennials.
It's
millennials and Gen Y.
It's a massive. It's a massive shift. I share my office complex. I share one floor with a real estate company that's been in business 20, 25 years. And their business has totally and absolutely collapsed. And matter of fact, they're fighting for their, I don't know if they're going to survive. And I was talking to the owner and I asked him what the problem was. And he was about to come back and spew a whole bunch of information. And I could see he really thought about it. And then he said, Gord, and it was an honest comment. He says, Gord, the young people aren't buying houses. Mm-hmm. That was the issue. The core central issue is the youth just are not buying. And I was sitting with a group of people my age, and we were talking about our kids, and we were talking about housing, and asked them when they bought their first house. And everybody in the group had bought their house between 24 and 26 years of age. This is back.
Same here.
Let's just say it was a long time ago. So I said to him, I says, okay, when did your kids buy your first house? So all the kids are in the ages of 28 to 37, and they all busted up laughing. None of their kids had bought houses. Matter of fact, the conversation got about them still living at home. Mm-hmm. And I think one had bought a house, but it was such a dramatic difference. You take 10 years minimally out of a housing market at run rates.
A lost generation.
A lost generation, but it's this new generation, not mine. Now you've got 75 million baby boomers beginning to retire. Their wealth is in their home, and they've decided they don't quite need the same size home, whatever the reason. Less space, can't keep it up. That's a lot of supply, and where's the demand? So I'm not trying to preach that housing is going to collapse, but I don't see it as going to be the driving engine of this economy.
No, it's going to be a rental economy, a rental market for this,
which it is already.
Future, yeah.
You can see it where the investments are, and everything's going to rental, and more investors themselves are looking at putting their money in a rental investment because I find that they're looking at it and saying, look, it's tough when I put in to really make sense of the investment because of what I'm paying and the taxes and the upkeep and the risk against trying to keep the thing rented and the occupancy. But Gord, at least I'm getting some return on my money. Right now at the bank, I'm getting nothing. I don't trust the stock market. And some money is better than no money. And by the way, I feel just more comfortable that I've still got a hard asset there.
Yeah. Oh, for sure. I mean,
that's fear.
Our sponsor, Jason Hortman, this is what he's counting on because the owner percentage, the percentage of you owning your own home has dropped from like 67% to 62% since the glory days of 2006. I think that was when it peaked, 2007. And we're becoming a rental society, which in and of itself, there's nothing wrong with. And especially because Gen Y and the millennial generation, Gordon, we were talking about before, are burdened by student loans, and they just, you can only serve one master. And if your master is your student loan debt, how are you going to go take on a mortgage on top of that? You can't qualify for a mortgage if you're paying $1,000 a month on student debt, right?
Absolutely the issue. The student loan debt payments are in many cases double what I paid for a mortgage payment when I graduated. So
yeah,
it's a showstopper for the youth today. It's an impossibility. So, which begs the question, will they even pay back the student loan debt? Can they it was tough enough for our generation to handle the mortgage payments, but can these kids manage all their other expenses and pay back their student loans? And my answer is, Kerry, no. I think defaults on student loans is a massive problem. And you and I were talking before the show of the games that are going on there and the obfuscation and misinformation that's hiding what the real problem is in the student loan marketplace.
Yeah, well, you mentioned that we've got almost $1.3 trillion worth of student loans, and yet
they're only reporting that we have $768 billion of outstanding loans. And I was saying, where did the other 500 plus billion go?
Yeah,
and I don't understand. So I started really skinning the onion and peeling the onion on this one, trying to figure out what was going on. And what it is the denominator went down because when you have, we used to measure things called first of all, you have delinquencies. They're in arrears, and you measure those, and then eventually get to the point where you know you can't pay it, so it's a default, and you look at the default rates, and that's how we measure all these bad loans. Well, they've got this new thing now called forbearance. And what forbearance is are all these government programs that allow you not to get out from under your student loan, but to push out the payments into the future. And when it's in this forbearance category, you're really delinquent and you're really in default because you can't make it. Therefore, you qualify for these programs. It comes out of the denominator. So there's only $768 billion on this bottom line. So does that mean we got $500 billion of programs that have been put out for forbearance? Well, the answer is pretty well yes. And I know you were just listing a whole pile of the programs that are available.
Yeah, you go work for your congressman. You make 10 years worth of payments, and you work for your congressman, your senator, and guess what? Your debt gets forgiven. Isn't that great? Or work for a nonprofit, qualified nonprofits. There's a whole plethora of organizations you can work for and get your debt forgiven. National Guard, the Army, just some of it maybe makes sense. Some of it probably overly generous. We could debate that. But then there's also an income test, and there's a cap on payments now. So you pay the maximum that you can pay for a certain amount of time, either 10 or 20 years. And then that's it. You're done. The rest gets forgiven. All of this has been done by executive fiat or regulatory fiat. It's questionable whether it's legal or not, but we're living in an era where it's just complete lawlessness has taken over.
Yeah, it's executive order now. It's not even congressional bills, which is begging a lot of questions. So, we got Obama coming out with the State of the Union saying, well, community college should be free.
Yeah.
And
life.
So if you go to university, you're going to be college, you're going to be penalized. So there's going to have to be some adjustment. This is the camel's nose under the tent. This is just the beginnings. And so all those forbearance will be forgiven at some point. That's my personal speculation.
No, you're right.
And I was saying to you there earlier, the little towns that I'm in Massachusetts, they're starting to do now here, because they have horrendous pension issues, and that they just can't even, because they pay as you go. They didn't put any money aside. They're now offering that if you work for the town and do community work, you get tax relief off your taxes. So it's only a matter of time before students, if you do community work or whatever kinds of programs, you will be able to work off your debt or your forgiveness that way, or forbearance. A new form of, as I said, Peace Corps, whatever they want to call it. I can see these, you can just see it shaping up. And they have to do it because we need to pump 1.3 trillion more money into this hole we've got, that removal of quantitative easing is hurting us, because we really do have real liquidity problems looming here, because we brought so much of this demand forward with quantitative easing, supply and demand.
Yeah, it's basically a giant version of cash for clunkers when you get down to it, because all you're doing is taking demand from the future and moving it up. It's the inverse of savings, right?
Exactly. That's the essence of the problem with quantitative easing. You make interest rates really cheap, so suddenly, if you're a buyer, you can afford things. You can afford more debt, things, so you buy. If you're a supplier, you look at the demand and you say, wow, look at the rates, and you can borrow money, you can refinance the factory, so you build. So what happens is demand and supply shoots up, but very quickly they come into balance. But they come into balance at a higher level. Well, right behind this demand and supply you brought forward is this big hole. This giant hole. So how do you fill it up? How do you bring even future demand forward? Well, that hole goes exponentially for your ability to bring future demand, or at least demand, forward. But what's happening when you print the money, Kerry, is then you've got inflation working its way through. So suddenly your real disposable income for the consumer with the demand falls off. And that's what's happening. Demand is falling and accelerating. And when demand falls, all of a sudden commodities start to fall because there's not the same use there. And commodities are used as collateral to finance the credit, as we've seen in India and we've seen in China, et cetera, et cetera. So suddenly then we have all sorts of credit problems. And that's why we've seen the oil shocker. That's why we're seeing you saw Switzerland coming off the peg because it just couldn't hold up against the devaluing euro, which is even now with Draghi at 60 billion euros a month, is going to drive this thing down to parity. So these are cracks that all stem from this fundamental flaw in quantitative easing. Yeah. I mean, it's more than just that. I'm being very simplistic, but that's the essence of it.
And then you have taxes going up also,
Precisely.
Which lowers your disposable income. So you don't really get ahead at all. Prices go up. Prices go up on the things you need, not necessarily the things you want. And then you've got credit going up. So where does it really get you?
It doesn't get you anywhere because what's happening is our standard of living is falling steadily. And I'm not talking about all the materialistic things that we have, but our standard of living is falling. And because there's this giant wealth transfer that's happening, and that is wealth that's going from the individual to help pay off the government's debt. And what that is wealth, Kerry, is really purchasing power. If you own gold, it's not the gold per se, it's what that gold will get you. In other words, what it'll buy, it's your purchasing power. So when you reduce people's purchasing power, their wealth is falling off. But that is not lost. It's transferred to the government because the government still has the purchasing power because it issues new currency at today's price and pays off yesterday's currency at old prices. So there's this shift, but we don't see it because we say, well, where did the money go? It's purchasing power. That's wealth today.
Very subtle.
That is it. It's so subtle, but it's all based on this thing called the money illusion. It doesn't work when money is a store of value. And when it always used to be a store of value, it's no longer. It's a fiat. So it's the good faith of the government. But if they want to print money, there's no store. So you don't win. So it penalizes savers. It penalizes anybody in that, pensioners, anybody in the retirement side. What it rewards is those who are highly leveraged or have huge amounts of debt vis-a-vis the government and the banks. Right. And I don't mean to pick on them. I'm just explaining why they have no choice, Kerry. The entitlement programs and the pension problems are so horrendous that the only way out of this is this process, which is a reduction of standard of living.
Yeah. They got to get paid. It's that simple.
Well, when they wrote this concept is called financial repression. And when they originally were putting papers together on this whole concept, they called it a liquidation tax. And then some smart guy said, we better not call it that.
Yeah,
but that's a good idea. That's not a good idea. So that got stroked out of the paper. So it's not called a liquidation. But that's what it was. It's the only way of liquidating the debt down to some manageable level. You know, in the Syrian generation era, 20, how many years ago? 4,000 years ago, they had debt jubilees every 49 years. And it was kind of the same. It was a standard process. Otherwise, the government got overthrown. And so they just throw the money lenders out. And even in the Bible, usury fees were never
7 years and
never allowed. Exactly.
And a grand jubilee every 49 years.
That's how it worked. And so these are not new problems. And the Romans would clip their coins. So that's the kind of way, instead of printing money, they just round the edges. It's every generation. It's the same time and time again. Except today it's a little bit more subtle in terms of the words, but it's the same issue. Too much debt.
And the same solution coming up. So either you buy gold and silver or you're going to get burned, right?
Well, I wouldn't just say gold and silver, Kerry. They're tremendous stores of value, no question. We'll debate whether the government's going to tax them and what's going to happen there. But you need to be in things other than just paper, because paper are claims on assets, and there's an intermediary, and then there's the ability whether, in fact, you will get the claim. You need to be in things that are real. Well, I refer to them as hard assets.
Yeah.
Things of real stuff. Things that have purchasing power if they're tradable. In other words, I've got this physical item and I know somebody will give me something I want for it. If you've got a piece of paper in your hand, people say that's only a claim on something. I don't know if I want that claim. And when the system starts to, people get nervous and they stop trusting the system, and systems break down, as we've seen in Greece. So as you see shocks in Switzerland, you see these, and we're seeing more and more of these events that are very disruptive. We start to worry about collateral damage and third-party and counterparty risk. Mm-hmm. These are the essence of an inflated credit and debt society. I don't mean to sound really negative here, Kerry. It's just that it's a time to be prudent and understand risk.
Yeah, be realistic.
Be realistic with your assessment. Get a good advisor and really understand the risk that you're taking. Because right now, I look at for example, the stock market. I think personally, there's incredible risk compared to what there used to be. That not saying that the market won't continue to go up.
Yeah.
That doesn't mean it's really got true value in it. It just means that money's becoming worthless.
Yeah, and there's no other place for it to go.
Oh yeah, exactly. If you're a fund manager, you're paid to be invested. You're not paid to be sitting there in cash, and your portfolio and your prospective says you've got to be in either equity, stocks, or bonds. Pretty small pool, right? Even though there's no fish there, you got to throw your hook in.
That is true.
But you and I want.
What choice do you have?
You got, but you find a new fishing hole.
Yeah.
And maybe you're fishing in the wrong hole for this period of time. Mm-hmm. For this period, maybe these kind of instruments are not necessarily the right instruments. I don't know. I'm not trying to say that. I'm just trying to say make sure that you're thinking this through.
Yeah, and have a little diversification into other assets that
always, no matter what time it is, when, even if stocks and bonds, you should always, diversification is absolutely critical. And diversification is not just instruments, but countries and currencies. Currencies, I think, today are playing a bigger and bigger role in any investment.
Yeah. Well, look at the Swiss franc, the euro. Look what happened there. We should talk just for a moment about that, debacle there. And hey, look, everybody thought it was so easy to make money in foreign currencies as long as these pegs were guaranteed, right?
Yeah.
It's a guaranteed peg.
I think, Kerry, I think these pegs are all. I think the Swiss franc dropping this peg is only the beginning of these pegs collapsing. We've seen the ruble. It stopped the peg. It stopped trying to shore it up. It went off it. I think that Denmark's got issues. The Danish krone has got serious problems right now. They're already talking about it. I think Hong Kong's got a problem. And though the yuan, remembering in China is not officially pegged, it's tried to help the U.S. dollar. But if you look at against the Japanese yen, and we know that the yen has been in free fall against the U.S. dollar, you should see it against the yuan. Yeah. And so if you're China and you got your competitor across the channel there with this kind of advantage, how long before you say you got to do something? You're just going to take it right in the chin. I don't think the Chinese people are going to do that.
No, not for.
They're being forced into a currency war.
Yeah.
So once that elephant starts to move, that'll make what happened in Switzerland seem pretty minor if it happens. But all these pegs are in trouble because our currencies, the game we're playing with these currencies. Mm-hmm. And the U.S. dollar should be, in my opinion, nowhere near the strength that it is right now. But we've had $9 trillion since we started printing this free money that wasn't invested in America, Kerry. It left America in a nanosecond, went into the emerging markets because they said, hey, the dollar is going to fall. So, you always borrow, the cardinal rule is borrow in a currency that's going to fall, pay it back in devalued dollars until they borrow, and cheap money. So they started investing in all these emerging markets with this cheap money. That my comment about supply. So the supply just went up with these new factories, et cetera. Well, all of a sudden, when the dollar goes up, you're on the wrong side of the debt. So now you got to pay it back. Your currency's falling. You got to pay it back in bigger dollars. And demand is falling off for all these things you invested in. So there's this panic buying or covering, if you would, of the U.S. dollar. So the more it goes up, the faster it drives the covering.
Isn't that amazing?
Well,
I would have thought this was going to happen.
The only people who thought this might happen are those who were involved in the $700 trillion swaps market. There's always somebody that makes money on this, Kerry.
That's a great point there.
And you know who owns and guess who owns the $700 trillion swaps market? Well, the big banks in America all have over $70 trillion in derivatives. So
right. Yes. Very, very true. The people in the know, right?
There's no surprises here.
Yeah. Yep.
You don't when you're running trillions of dollars, you don't speculate.
Yep.
And by the way, when you're moving trillions of dollars, the market follows you.
Mm-hmm.
Right? Those flow. You start moving any kind of money of that amount. The currency markets trade about $5 trillion a day. You start putting some big movements in it. You can influence it, but there's no regulators.
No, that is the biggest market in the world, right? The currency markets.
And it's totally unregulated, unpoliced. The only people who have any visibility to it are the major international banks.
Mm-hmm.
And we have a $700 trillion swaps marketplace. It's reported out of the Bank of International Settlements in Switzerland that has completely and totally over-the-counter, no visibility at all. None. Zero.
Yeah.
And when you put that into perspective, the U.S. economy is only $25-30 trillion. It begs a lot of questions. How could we allow that to happen in this day and age? And the shadow banking system's running $72 trillion. How can this be?
Good question. How can it be?
How can it be without more visibility and more tracking? And okay, let's assume that there's good reasons for it, but it starts to beg a question of the kinds of controls that it has on markets, on influencing interest rates and bond rates.
Yeah, well, we're going to have to talk about the currency exchange markets next time. Gordon, just tell us your website, how we find out more about you, and follow you on the web.
Yeah, please. Thanks, Kerry. Just Google Gordon T. Long or GordonTLong.com or our YouTube channel under the same name where we do things on financial repression, et cetera.
All right. And of course, you'll find the link to Gordon's site on financialsurvivalnetwork.com. Make sure you sign up for the free newsletter. Gordon, we'll be talking to you again soon. Thanks so much.
Well, thank you very much, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.